Even if you have no intention of investing in Elon Musk, you could get pulled into this. SpaceX is about to land on the stock market in what could become one of the biggest financial events in history. But here's the twist. This isn't about rockets anymore. Elon Musk is racing two of the most important AI companies, OpenAI and Anthropic, to the market.
This is going to put so much stock out on the market at such high valuations, I think it could actually turn the market.
This is really going to take things to the next level.
All three are chasing trillion-dollar valuations, and all three want your money. And whether you want to invest or not, Musk has changed the rules of the game and could force you to come along for the ride. So you need to understand what he's trying to sell, why now, and how you could get pulled into all of this, just in case it all blows up. For years, Elon Musk said he wouldn't do this. SpaceX would not go public until there was a city on Mars because shareholders would be too impatient to back such a long-term mission. And yet, here we are, about to watch SpaceX perform the biggest IPO, or initial public offering, in history. The company will list on the stock exchange, so anyone, including you and I, can buy a share, and they can raise money. So, what changed? SpaceX famously pioneered reusable rockets. And with that, brought launch costs down dramatically, from around $18,500 per kilogram to $2,700 for the Falcon 9 to $1,400 for the Falcon Heavy. That's 92% less. And that unlocked the next business, to do with what's on top of the rockets, Starlink satellites. Right now, roughly 15,000 satellites are circling the globe, and 2/3 of them are Starlink. It's become a very successful and profitable business. But that's not the story SpaceX is asking investors to buy. When the company filed the paperwork to go public, one number got a lot of attention: $28.5 trillion. That is the market opportunity SpaceX says it's chasing. They call it, and I'm not making this up, the largest actionable total addressable market in human history. It is big, almost the size of the whole US economy. And only this small section relates to rockets and Starlink. 93% comes down to AI.
AI is mentioned more in the IPO prospectus than Jesus is mentioned in the Bible.
Why? Because earlier this year, Elon Musk folded xAI, the company behind Grok and X, formerly Twitter, into SpaceX. His pitch: data centers in space to solve the energy bottleneck.
If we wanted to use even a millionth of the sun's energy, the only way to access that energy, the energy of the sun, is to extend beyond Earth.
It's a genuinely interesting idea. It's also an unproven concept and relies on technologies that don't exist yet. More importantly though, it's still too expensive. Researchers at Google estimate that launch costs would have to come down to $200 per kilogram, or 1/7 of current levels, to become economically viable. So for now, it's a vision, not a business. And the filing leans into that. It talks about crazy new ideas for its future, like asteroid mining, or long-haul rocket travel, or this giant railgun for the moon that could catapult AI satellites into orbit. So that's the vision, but there's a catch.
It's reasonable to describe many of these businesses as money furnaces. They're spending a fortune.
Which explains why all of this is happening now.
So when you're burning that much money, you need to raise money. And
let me show you what he's talking about. Of the three business segments, Starlink brought in the most revenue last year. And only Starlink is currently profitable. AI lost $6.4 billion last year and swallowed $12.7 billion in investments for data centers and chips. And then another $7.7 billion in just the first 3 months of this year. So far, private investors have been funding this. But at some point, the check becomes too big. It's a very similar situation that OpenAI and Anthropic find themselves in. Take OpenAI. It has plans to spend roughly $600 billion by 2030. That's double what America spent on going to the moon in the Apollo years, adjusted for inflation. The only way to raise some of this cash will be to sell shares on public markets. And it explains why these three companies are racing each other.
the problem is when all of these massive companies go public at once, the question is there really enough money out there to fund them all? And so to a certain extent, I think they're racing to get to market first so that they get the money before, before it's exhausted.
But getting the timing right will be critical. Because since the war in Iran broke out earlier this year, something strange has been happening in financial markets. With no oil coming through the Strait of Hormuz, oil prices jumped more than 50%. Now, normally, an energy shock like that would drag markets down. Instead, they've kept climbing. Why? Because optimism around AI has lifted the entire market. Some are calling it an AI boom, others a bubble. Remember this guy from The Big Short? That's Michael Burry. He's the fund manager who predicts the housing crash before everyone else. Now, he's convinced that AI too will come crashing down. He may or may not be right, but it explains the rush. Because that same wave of AI excitement that's holding up the entire market is the wave these three companies want to ride, before perhaps it breaks. Unless, of course, they're the ones who break it.
This is going to put so much stock out on the market at such high valuations, I think it could actually turn the market.
It's a moment of real jeopardy, because when they go public, these companies will have to open their books for the very first time, and that can go wrong. When WeWork prepared its IPO, it was one of the most hyped new companies, valued at $47 billion. Then, investors saw their books and, crucially, their losses, and instead of listing on the market, the company went bankrupt. It shows just how quickly the focus can shift from how revolutionary a company is to what's the right price.
This will be the most expensive stock out there, the most expensive stock I can think of.
So, let's take a look at the numbers. For its initial public offering, SpaceX is selling only a very small slice of the company, 556 million shares, or 4%, at an expected price of $135 per share. That raises $75 billion in proceeds in one go, more than double the current IPO record holder, Saudi Aramco. It also implies an enormous valuation for the entire company, because if you apply that same share price to 100% of the shares, the company value reaches $1.77 trillion, which would immediately make SpaceX the 8th largest public company in the world. OpenAI and Anthropic are chasing similar territory, somewhere around the $1 trillion mark, also joining the top 15. But there's a problem. All these other companies on the list are profitable. SpaceX, OpenAI, and Anthropic are not, at least not yet. In fact, if you compare how much money they bring in as revenue, SpaceX drops to rank 689. So it is true, this would be one of, if not the most expensive stock on the market, because you're essentially paying more for every dollar the company actually earns than anything else out there.
It's a hype investment. It's, it's vibes based.
Vibes is an interesting term for it. Hope could be another term for it.
You ask anyone why they're investing, they don't say, oh, well, I've gone through the accounts, Grok is the best AI or anything like that. They say, never bet against Elon.
Well, you might not get a choice. Remember how I told you that you could get pulled into this, whether you want to or not? There are two ways that happens. The first is on you, but you might not even notice the second. You've probably seen ads like this from banks telling you can get early access to SpaceX shares. That's not normal. Usually, when a company goes public, the best access is reserved for Wall Street, big institutional players like banks or investment funds. But Elon Musk has a lot of fans and he wants their money too. So he's reportedly reserved a large chunk of shares for ordinary investors.
There's an argument, the argument being made is that it's democratizing finance. It's going straight to the people.
You could also argue the other way.
Well, it's sort of almost, how a restaurant or a bar is cool is that they won't let you in, And the very fact that anyone can sort of open an app and be offered these shares doesn't imply to me that the demand is out of control.
But even if you never buy a single share, you could still end up owning a piece of SpaceX. Here's why. A lot of pension and ISA money sits in so-called index funds. They don't pick individual stocks, but track a group of companies, like the 100 biggest on the Nasdaq exchange. Normally, there are strict rules on who gets to join these groups, and newcomers would have to wait for months. But we've established at this point that this is not a normal IPO. SpaceX got that wait cut to 15 days after Nasdaq changed its rules. So when they join the index 15 days after the IPO, it triggers a wave of automatic buying. And that could push prices up.
So the fact that the index funds are basically suspending their actual rules just to add SpaceX stock so that every person in America will have to own this at the highest possible price to start is just disingenuous when they have a system that has worked for a very long time to vet companies for the S&P 500.
Nasdaq's argument is that the world has changed and companies go public much later when they're bigger. The new rules simply reflect this new reality.
You have to imagine if this goes badly, that there'll be lawsuits.
It is worth pointing out that not every index played along. The S&P 500 didn't change its rules. So now that you know you're involved, how could this all go terribly wrong? Well, here are 3 things to watch. First, Starship. That's SpaceX's next generation rocket. If they can get it to work, it could bring launch costs down enough to make AI data centers a realistic business. But that's a big if. After many delays and failed attempts, the rocket still hasn't reached orbit. And this was what their most recent successful test flight looked like. The second risk, AI. For now it's booming, but what if the mood shifts? Take Anthropic, the maker of Claude, which has been killing it recently. So much so, they've signed a contract to rent some of SpaceX's computing power to meet demand.
Actually, this is the first year we've grown faster than the exponential. So, we tried to plan very well for a world of 10x growth per year. In the first quarter of this year, we saw, if you were to annualize it, 80x growth per year.
Ooh. The recent success comes down to its viral agentic tool, Claude Code. So many people have been using it, annualized revenue jumped to $47 billion, soaring past OpenAI. But that popularity could become a problem. Uber revealed its employees blew through the company's annual budget for Claude credits in just 4 months. And this explains why. Anthropic is currently almost 20 times more expensive than DeepSeek, its open source competitor from China. If all this competition puts pressure on prices, what does that mean for AI's path to profitability? And then there's a third, and perhaps biggest risk, which brings us back to him, Elon Musk. You can buy as many shares as you want, but he keeps roughly 82% of voting power.
Basically, this is a company controlled by Elon. He's going to do what he wants. The board is all his friends. And if you're investing, just know that you have no say on anything. And if you don't like it, too bad.
Investors that are buying into this, you're betting as much on Musk as you are SpaceX. Now, is that key man risk? I mean, of course there is.
So 3 companies, none of them profitable yet, and all racing to sell shares to the public before the mood changes on AI. SpaceX will go first, and the market will get to decide what this company that builds rockets, AI data centers, and, if all goes to plan, a future Mars colony, is really worth. And you, whether you back it on purpose as one of Musk's fans or without ever realizing it through a pension, could end up owning a piece. So what do you think? Is this the opportunity of a generation or one of the most expensive bets in corporate history?